Imagine this. You've diligently built a strong credit score. You feel ready for that dream home, only to have your mortgage application hit a wall or offer a rate that makes you gasp. What if I told you the credit score lenders see isn't the one you're checking every month? And what if there was a little-known trick, a secret weapon hiding in plain sight that could unlock thousands, even tens of thousands in savings on your mortgage? Stick with me, because today we're exposing exactly what lenders truly see, why your FICO might be failing you, and the swift, impactful strategy to transform your mortgage future. By the end of this video, you'll know exactly how to gain an edge most people never even realize exists. Are you ready to stop leaving money on the table? Let me know in the comments if you've ever felt blindsided by a loan offer. Many people, just like you, work hard to maintain excellent credit. They monitor their FICO score, celebrate when it hits the 700s, maybe even the 800s. They feel confident stepping into a bank, expecting the best mortgage rates. But then comes the shocker. The lender quotes a rate that's far higher than anticipated, or worse, outright denies the loan. It's a frustrating scenario we call the mortgage trap. Take a hypothetical case. Alex. Alex had an 800-plus FICO score, pristine payment history, virtually no debt. Yet when Alex applied for a mortgage, the rate quoted was a quarter point higher than what the lender advertised for excellent credit. A quarter point? On a $300,000 loan, that's tens of thousands of dollars over the lifetime of a 30-year mortgage. It's confusing, it's disheartening, and it leaves people wondering, what did I do wrong? The answer might surprise you, because what you think is your credit score isn't what they're looking at. So how do you navigate this opaque world of mortgage lending and ensure you don't fall into the same trap as Alex? This video is your comprehensive guide. We're going to pull back the curtain on the specific, lesser-known metric that mortgage lenders prioritize, debunk the common credit score myths that are costing you money, and then hand you a precise three-step blueprint to boost this particular score fast. And finally, we'll talk about the optimal timing to apply these strategies to maximize your mortgage savings. Are you ready to see the blueprint that changes everything? This is where it gets interesting and where most people miss a crucial detail. While your general FICO score is a good indicator of overall credit health, mortgage lenders don't just look at FICO Score 8, which is what most free credit reports show you. No, they dig deeper. They use older, specialized FICO scoring models. FICO Score 2 for mortgages, FICO Score 4 for auto loans, and FICO Score 5 for credit cards. These older versions, specifically FICO Score 2, 4, and 5, often known as classic or industry-specific scores, weigh different factors with varying importance compared to the newer generic FICO Score 8 or 9. For mortgages, these older models place a much heavier emphasis on specific aspects of your credit report, such as installment loan payment history, think student loans or car payments, and how you manage revolving credit utilization. They want to see a long, consistent history of on-time payments, especially on debts that are similar to a mortgage in structure. Moreover, they scrutinize your revolving credit utilization with an eagle eye. While a 30% utilization rate might be acceptable for your general FICO, for these older mortgage-specific scores, it's often considered too high. Lenders want to see your credit card balances at close to zero as possible. They interpret high utilization, even if paid on time, as a sign of potential financial stress or a higher risk appetite. So you could have a perfectly good FICO Score 8, say a 760, but your FICO Score 2, the one the mortgage lender sees, could be significantly lower, perhaps a 720. That 40-point difference could mean a higher interest rate, thousands of dollars lost, or even a denied application. It's not about what your general FICO is, it's about what the mortgage FICO is. Understanding this distinction is the first, most critical step to unlocking significant mortgage savings. But knowing this alone isn't enough. You need to know how to move the needle on that specific score. Now that you understand the hidden score, let's talk about the surgical, three-step blueprint to boost your mortgage-specific credit score fast. This isn't about general credit repair, this is targeted optimization for your home loan. Step 1. Optimize your revolving credit utilization to ultra-low levels, ideally under 10%, and even better, under 5%. And here's the crucial part. You need to pay down your balances before your statement dates. Why? Because your credit report reflects the balance reported on your statement date, not necessarily your current balance. So, if you run up your card during the month and pay it off before the due date, that high balance might still be reported, negatively impacting your utilization. Pay it down days or even a week before your statement closes. This might mean adjusting your spending habits slightly or making multiple small payments throughout the month instead of one large payment at the end. For instance, if your credit limit is $10,000, aim to have no more than $1,000 reported on your statement. This signals financial discipline and low risk to mortgage lenders, telling them you manage your revolving debt extremely well. Think of it like this. Your credit card is a powerful tool, but for mortgage applications, you want it to appear almost untouched, like a safety net you rarely dip into. This single action can provide a rapid boost to those sensitive mortgage scores. Step 2. Maintain a flawless payment history, especially on installment loans, for 12 to 24 months. While all on-time payments are important, consistent, perfect payments on installment loans, like car loans or student loans, are heavily weighted by mortgage lenders. They mirror the long-term commitment required for a mortgage, proving your reliability over an extended period. If you have any delinquencies, focus intensely on bringing every account current and maintaining perfect payment behavior moving forward. Every single on-time payment builds your trustworthiness in the eyes of a future lender. Set up autopay, use reminders, do whatever it takes to ensure you never miss a payment. Even one late payment within the past year or two can drastically reduce your mortgage score, more so than it might affect your general FICO. This isn't just about avoiding penalties. It's about building a robust history of financial responsibility that directly impacts your mortgage eligibility and rate. And finally, Step 3. Avoid strategic credit sabotage. This means no opening new accounts, no closing old accounts, and no making large, unessential purchases before and especially during the mortgage application process. Opening new credit lines, even if you don't use them, can temporarily lower your credit score due to the hard inquiry and the reduced average age of your accounts. Closing old, unused accounts, surprisingly, can also hurt by reducing your overall available credit and shortening your credit history. And large purchases, particularly if they involve taking on new debt or significantly increasing your revolving balances, are red flags. Lenders want to see stability. They want to see that you are financially settled and prepared for the massive financial commitment of a mortgage. Any sudden shifts in your credit profile can make you appear riskier. So, hold off on buying that new car, opening a new store credit card, or making any big-ticket credit purchases until after your mortgage is closed. This period of credit hibernation is crucial for presenting the most stable, attractive financial picture possible to lenders. Remember, every decision you make in the months leading up to your application will be scrutinized. These 3 steps are not quick fixes for everyone, but they are the most effective levers you have to pull to directly impact the specific credit scores lenders care about most. If you implement these, you'll be amazed at the difference. Now, let's talk about the payoff, maximizing your savings, and when you can actually unlock them. These credit optimization efforts aren't a last-minute sprint. They're a strategic marathon that you ideally begin months before you even think about applying for a mortgage. The sweet spot? At least 6 to 12 months out, allowing enough time for positive changes to ripple through your credit report and for those older FICO models to catch up. But even 3 months can make a significant difference. The impact on your potential savings is truly staggering. Let's revisit Alex's example. That quarter-point higher interest rate on a $300,000 loan over 30 years translates to over $15,000 in additional interest paid. Imagine what you could do with an extra $15,000 in your pocket. What if you could save half a percentage point? That could be over $30,000. These aren't abstract numbers, these are real dollars that stay in your bank account, not a lender's. A higher mortgage credit score can shift you into a lower risk tier, unlocking preferred rates that can save you hundreds, even thousands every single year. It's not just about getting approved, it's about getting the best deal, one that fundamentally alters your long-term financial landscape. Don't underestimate the power of these seemingly small rate differences. They compound into immense savings over decades. This knowledge gives you power. You now possess a powerful, lesser-known strategy to avoid the mortgage trap. Understanding the specific credit scores mortgage lenders use and how to precisely optimize them isn't just about saving money. It's about gaining genuine financial empowerment. It's about securing your future, creating a foundation of peace of mind, and freeing up resources to pursue other life goals, whether that's saving for retirement, investing, or simply enjoying life more. Don't let a misunderstanding about credit keep you from your home ownership dreams. You have the tools now. Your next steps are clear. Take this knowledge, run with it, and start implementing these strategies today. If this video opened your eyes to something new, do me a favor. Hit that like button, subscribe for more powerful financial insights you won't find anywhere else, and share in the comments one credit myth you're now ready to discard forever. Your engagement helps us reach more people who need this vital information. Now you have the insider knowledge to make one of the biggest financial decisions of your life with confidence. No more guessing, no more feeling blinded. You have the blueprint to optimize your credit, secure those lower mortgage rates you truly deserve, and achieve a level of financial freedom many only dream of. Go forth, conquer your mortgage, and build the future you deserve.